今天我们要深入探讨的是一场由知名投资家凯西·伍德 Cathie Wood 带来的演讲。凯西·伍德是 ARK Invest 的创始人兼首席执行官，以其对颠覆性创新和技术驱动的投资策略而闻名。在这次演讲中，他围绕当前的经济形势、政策变化以及市场趋势展开了详细的分析，并分享了他对未来经济和技术发展的独到见解。在这次演讲中，凯西·伍德讨论了多个关键话题，包括1. 经济衰退与复苏。他认为，尽管美国经济在过去几年经历了持续的经济衰退，但可能正在接近尾声。他特别提到，生产力的提升将成为推动未来经济增长的核心动力，同时通胀可能会继续下降。2. 财政与货币政策。凯西分析了当前的减税政策和放松管制的潜在影响，认为这些措施将刺激经济活动，并可能加速名义 GDP 的增长。他还提到，货币流通速度的下降可能会对经济增长产生一定的抑制作用。3. 市场指标与消费者信心。他通过多个图表展示了当前的市场状况，包括收益率曲线的变化、消费者信心的波动以及就业市场的不确定性。他指出，尽管消费者信心有所下降，但未来可能会随着政策的实施而逐步恢复。4. 技术创新与未来机遇。凯西特别强调了人工智能和其他颠覆性技术的快速发展，认为这些技术将成为推动未来经济增长的关键力量。他还提到，开源运动在人工智能领域的兴起可能会对行业格局产生深远影响。凯西·伍德的演讲不仅提供了对当前经济形势的深刻洞察，还为未来的投资方向和技术发展趋势提供了有价值的参考。无论你是投资者、经济学者，还是对科技和创新感兴趣的普通观众，这场演讲都值得你深入思考。接下来，我们将通过详细的解说和分析，带大家更全面地了解凯西·伍德的观点，并探讨这些观点对市场和经济的潜在影响。让我们一起进入这场充满洞见的演讲吧。关注本频道，跟我们一起掌握最新动态。
Greetings, everyone. It is Employment Friday, and this is Cathie Wood, CEO of ARK Invest, to talk a little bit about what we believe is going on out there and how this might propagate into the future in terms of, fiscal policy, monetary policy, economic activity, market indicators, and of course, innovation. Now, I think the shocker to a lot of people is we've entered here in 2025, and the Fed Atlanta's GDP Now indicator suggests that the first quarter will be down in terms of real GDP growth, down 3% at an annual rate from the fourth quarter to the first quarter. And that has unnerved a lot of people because the economy seemed to be doing fine. But as you know, if you've been watching In the Know for a while, we've been talking about a rolling recession since the Fed started jacking up interest rates in 2022 for 3 years, a little more than 3 years now. We believe we've been in a rolling recession, and we're coming to the end of it. So that's the good news. The bad news is we do have to go through this process. Bottom line, however, we think after this initial shudder that the equity markets are going to look through whatever the next 6 months holds in terms of economic activity into a future where we see productivity driving real GDP growth at an accelerated rate in an exciting way. And at the same time, inflation continuing to come down because productivity is going up. Productivity is a powerful antidote to inflation. And we think we're probably on the threshold of some of the most important productivity gains in history. So just wanted to set the stage this way. Before we go on, what is happening in these first 6 months of the year? As you know, there was a lot of hope coming out of the election that we were going to be on our way in terms of the equity markets health and the broadening out of the equity market as a sign of its health. And it has begun, but as always, 2 steps forward, 1 step back. So let's talk about the 1 step back. In terms of fiscal policy, from our point of view, the most important proposal out there right now is the $4.5 trillion tax cut that did make it through the House. They passed a budget with a $4.5 trillion tax cut in it. And that's in addition to the $1.9 trillion tax cut that is part of the Tax Cut and Jobs Act, TCJA. That was scheduled to expire at the end of this year. And we don't think it will expire. This $4.5 trillion is on top of that. Now, you must be wondering, what the heck is going on here? That just sounds like a bigger deficit, a bigger hole out there. Well, those numbers are over a 10-year period. But I think one of the most important things we're learning is that the tax rate cuts themselves will be retroactive to January 20th. Now that's not cast in concrete at all, but we have heard in and around the administration talk of retroactive tax cuts. Why is that so important? Well, we learned from the Reagan Revolution that phasing in tax cuts is a recipe for a very deep recession, because people and businesses defer economic activity in order to capture the lower tax rates. And so I think this administration has learned from the Reagan administration that phasing in is not a good idea. So that is very important in terms of information. The Senate version of the budget is not out yet. And then we'll have to go through a reconciliation. I think what's so interesting about the way that President Trump has set this tax cut up is in terms of what people know is going to take place. And I think the president repeated it in his session to Congress this week. No taxes on tips, Social Security, or overtime. Now, those tax benefits are very appealing to the lower and middle class, which tends to benefit from those 3 sources of income. And so President Trump and team cannot be accused of favoring the rich. I think the other thing we're going to see here is that the threats and actual reality of tariffs, which is causing a lot of consternation. I do not like tariffs. They are tax increases. But I think that the president, and we'll get into this when we go through the charts again, the president is hearkening back to the early days of our country, where tariffs actually supported the government. The primary source of income for the government way back then was tariffs. And then, of course, today, tariffs account for very little funding of government spending, and income taxes account for most of it, business and consumer. So we think that this tariff discussion and the actual imposition of tariffs is a setup for the last leg of this tax cut discussion and hopefully passage through Congress. We believe, and again, this is reading between the lines. Kevin Hassard, who's the president's top economic advisor, seems to be suggesting that the dream of a flatter tax rate structure is what the president is aiming for. He did a lot for corporate taxes in his first administration, taking them from 35%. We were some of the highest corporate tax rates in the world, I think up in the top 3, to 21%, and that took us into the bottom quartile. So from a competitiveness point of view, a very good move. I think he felt that that was an important first step, and that in his second administration, he would tackle the individual tax rate cuts. And in terms of stirring animal spirits and economic activity, we think that's very important, in fact, critically important. As far as deregulation on the fiscal policy side, we can tell that Gary Gensler's departure has made a huge difference in terms of crypto innovation in the United States, or digital asset innovation in the United States. We're hearing all kinds of stories of people being attracted back to our shores, having moved abroad and not even wanting to deal with U.S. investors for fear that the SEC might come after them. So this administration is celebrating, actually literally today, Friday, Employment Friday, is celebrating the digital asset revolution with leaders from the digital asset movement at the White House. So that's exciting. And the Federal Trade Commission is the other form of deregulation. M&A was really prohibited by and large by the last administration. So many smaller companies who had perhaps negative cash flow had no source of strategic price discovery. How valuable are the new technologies they're inventing and evolving? The larger companies will bid for new technologies if they are allowed to. And in the case of healthcare, even more so, because that industry is facing a $200 billion patent cliff. Meaning $200 billion, no, it's $300 billion of revenue falling off the patent cliff between now and 2030. And yet they weren't really allowed to do much in the way of M&A. And our companies, the companies who are creating all of these technologies and new ways, profound ways of doing things, were left adrift because no strategic price discovery. That is already starting to change. The other thing in terms of deregulation, the president has said for any regulation anyone wants to put in the federal government, 10 regulations will have to come off the books. In his first term, that was for every 1, 2 had to come off the books. So he's doubling, tripling, quintupling down on that. Doge really is creating the first recession in the government sector since, really in 30 years, since President Clinton and Newt Gingrich worked together to eventually get us into a surplus condition. The government is so much more bloated now than it was back then, that there's a lot more room for maneuver. And so we are going to see a recession in the government sector for the first time in 30 years. And as we know from business cycle analysis, anything that goes for 30 years without a correction or a shakeout gets more and more inefficient over time, and very often there's bad behavior. And of course, this administration is advertising a lot of bad behavior, unfortunately, in the government sector in terms of, in the case of Social Security, people receiving checks when they're not alive. So. We also can see the recession in the DC metro area. If I'm not mistaken, prices have dropped. I believe this is since the election. Prices in the DC metro area for housing have dropped something in the 20 to 25% range. And there is a record number of houses up for sale. We do believe that that this government is going to exacerbate that, because it will try to move departments outside of the area and share the wealth with other states. And it is likely to actually dissolve some departments and push those responsibilities back down to the states. So this administration is big advocate of states' rights and does believe that the federal government has subsumed a lot of states' rights. So now what I'd like to do is talk a little bit about why we probably are in the last phase of this rolling recession. And it is Employment Friday. I'm not going to spend a lot of time on the January employment report. It's January. There's a lot of, the February employment report. There was a lot of bad weather, a lot of distortions. But if I can give you a few statistics from other reports that have come out recently on unemployment. The Challenger survey shows that layoffs are up more than 100% year over year. This is a very volatile series. But in terms of actual numbers, I think in February, the number was 172,000 layoffs. And if you look at in the context of history, pre or since COVID, that number was in the 50 to 60,000 per month range. So that's a tripling. And then just to compare it to other recessions historically, in 08 and 09 and also 01 and 02, we got to a peak in terms of layoffs of 240,000. So this is getting awfully close to those. In COVID, the peak was understandably 400,000. I don't think we'll get anywhere near there, but that 172,000 put in perspective to 08, 09 and 01, 02. That was the financial crisis and the tech and telecom bust. It says the layoffs are getting up there. We'll also see in the National Federation of Independent Business report next week an indicator showing renewed weakness in employment, where the small business sector has been extremely weak for the last 3 years and is relapsing after a little bit of excitement after the election. We saw the ADP report. It was subpar, 77,000. And the only other thing I'll point out from this report today, government in total did add 11,000 jobs. More than all of them were at the state and local part of the government sector. The federal government lost 10,000 jobs, and we think that number is going to mount considerably. If we're taking a step back and trying to figure out why consumer and business confidence is falling now again, it's because there is a lot of fear associated with this transition from one administration to the other, and some feeling of chaos, and that's the art of negotiation. So we're taking that as such right now. But if you look at all government employment, so federal employment is less than 2% of the employment in the United States, but federal, state, and local combined is closer to 25%. And then you have quasi-government in education and healthcare, and you're talking about a third of the labor force. And so a lot of people are probably wondering, is my job at risk, or is this move shifting spending from the federal sector down towards the states going to help me? So uncertainty certainly is the watchword. The reason education and healthcare are important is if you look over the last 12 months, those two sectors have been responsible for, I think it's 95% of employment creation, and that's a 12-month moving average, but 95%. In the early days of the last administration, those two sectors accounted for only 10% of job gains over a 12-month moving average period. So we're paying very careful attention. And then, of course, there is the concern that technology is going to take jobs. AI is becoming so proficient. We know coding jobs are the number is starting to go down. There are, I'm sure, a lot of entry-level positions that are not opening up because of artificial intelligence and other technologies. So there is a lot of fear on the employment front. I'm going to start going through the charts now, and we'll try and get through them quickly to highlight with pictures some of what I've said, and then to end up in the innovation space. So here again, I've presented this for a while now, but this is what many economists are focused on, the deficit as a percent of nominal GDP. It is close to 8%, and you can see the little X up near 2.5%, 3%. That is Treasury Secretary's goal over the next 4 years. And with the help of Doge and all the cabinet heads now that Trump has called them to help with the streamlining, we think the deficit will get there because of measures that the government is taking now, and because we do believe that tax cuts and deregulation are going to turbocharge nominal GDP growth. The best way to grow out of a deficit, as Reagan did, or at least started the process in the early 80s, is to grow at an accelerated rate with increasing productivity. And as you can see in the early 90s, through 2000, the combination of the Clinton administration and the Gingrich Congress really did get us on the right path, and we ended up with a surplus that we have really not seen since the tech and telecom bust. We actually think we will see one. It may not be in this during this administration, but the wheels in motion, just like in the 90s, we think will carry forward. The momentum will carry forward. On the next chart, again illustrating tariffs, that was the source of government income in the early days of this country. And as you can see, the income tax and corporate tax rates did not come into existence until the early 1900s, nor did the Fed. And you can see the trade-off that's taken place. We think that President Trump is thinking about bringing back a little bit more of balance here. We'll see if he's able to accomplish it. But I think importantly, we'll need those tax rate cuts to offset the deleterious impact of tariffs. Now, many countries will offset tariffs by devaluing their own currencies, meaning the purchasing power of the dollar goes up. That's certainly what China did in the first Trump administration. So we'll see what happens there. Okay, on to monetary policy. We've shown you this this chart for quite some time. Money growth is 3.9% on a year-over-year basis. That's in the purple there. It had been negative, and monetary policy works with lags. That's why we put the green line, which is inflation. We've lagged it relative to, or I should say pushed ahead the money growth numbers. And as you can see, there's a little bit of consternation that inflation has not continued down to the 2% area or less. As you also know, we expect it to do so. The burden of proof is on us, to be sure. I think there has been a lot of pricing behavior recently as companies anticipate tariffs as part of their input costs and are trying to get ahead of it. But we think the resolution will be to the downside here, sort of following what money did. And one of the reasons our conviction about this has grown is the velocity of money, or the rate at which it turns over, is starting to roll over. When the velocity of money is moving up, people are confident, they're willing to let go of their money, splurge a little. That tends to turbocharge whatever monetary growth is out there. When the velocity of money turns down, then that detracts from the money growth out there. So on this next page, you can see the very long-term chart of the velocity of money. It has been in a downtrend since 2000. I think the reasons are, first, the tech and telecom bust was a real shock to the system. Then we had a little bit of a cyclical rebound in the 04-05 time period, and then continued down primarily because of the excesses that became clear in the housing sector, led to the crisis, the global financial crisis, which again put a lot of fear into consumers and businesses. So again, they hung on to their money, and that was exacerbated, of course, during COVID. There was a collapse in the velocity of money. You know, people seized up and just were very afraid to spend, wondering if we were going into a global depression. We've had this cyclical upturn from that extreme decline. And you can see we're starting to tip over. And if you look at the year-over-year percent change of velocity, which you see here, you can see that velocity turbocharged money growth when it got to 11% on a year-over-year basis. As of the fourth quarter, it's down to 1%. But if you look at it sequentially, velocity turned negative in the fourth quarter. I think it dropped by something around 1% from the third quarter to the fourth quarter. And we believe that fears about employment that I just described from such a huge swath of the employment base out there is probably going to cause a continued drop in velocity sequentially, which will turn into a year-over-year drop. So if money supply growth were to stay at 3.9% and velocity were to drop 1% on a year-over-year basis, then that would be a nominal GDP growth. This is mathematical. A nominal GDP growth of only 2.9%. And that would be either squeezing inflation out, squeezing real growth out, probably both. And so it didn't surprise us that the Atlanta Fed is now suggesting a decline of 3% quarter to quarter in real GDP. Now, some of that is a function of the massive increase in imports in the first quarter. In January alone, month over month, imports went up, I think, 12%. So on an annualized basis, that'd be the equivalent of well over 100%. So that's a real drag. Imports subtract from GDP. Now, the other side of imports, as they work their way through, is they either end up in inventories or they're consumed. So, we will see the other side of that import growth in the next few months. So let's see, we'll take you on now to, again, you can see the consumer was beginning to feel a little better about things, punctuated by, the election-related peak. And now it's unraveling a bit. And uncertainty, which is another metric in this index, is back near a record high. And that's understandable. There are a lot of moving parts as this administration takes over and owns its policies. And we also know President Trump, the art of negotiation, sometimes you need chaos to bring more and more people to the table. And that certainly seems to be working geopolitically. Another reason people are upset is, egg prices, bird flu, that's capturing a lot of attention, of course. But other prices have gone up in here. For a time, gasoline was going up. And this was the result, a backup in inflation expectations. The Fed really doesn't like to see this. And even more so, the Fed doesn't like to see this measure of inflation expectations, 5 to 10 years ahead, increase to a level we haven't seen since, goodness, it looks like the late 90s. It might have even been 1994. Interesting, that again is the period when Clinton and Gingrich were wrestling the government sector to the ground. And of course, inflation fears were part of the reason back then as well. Oil prices have turned back down, and this president wants another 3 million barrels of oil produced in this country. And so it's taking off all kinds of regulations to encourage it. And of course, OPEC is now telling us they're going to increase supply in April. So we think oil prices are going to go down quite a bit. And that certainly will feed into inflation expectations. So we expect these measures to turn down in the months ahead. Here's another reason for consumer sentiment being so cautious right now. The average work week is dropping, and as you can see, it's as low as it got in and around COVID. And it's in really recession-like territory, the beginning of the 08-09 downturn. Now, of course, January and February, there are weather distortions, so it remains to be seen if this metric is going to stay down and out like this. But it could, as employers try and cut back on the number of hours so that they don't have to pay benefits. I think fewer than 30 hours, if I'm not mistaken, companies don't have to pay benefits. So another reason the consumer's kind of holding back here just to see what's going to happen next. Here's another reason the consumer's holding back. Trapped in homes by mortgage rates that they got in the 2%, 3% range, now in the 6-7% plus range. And they can't afford to move, especially because home prices have not come down, except in the DC area. So we think if interest rates continue declining, and that is something that has happened here. Long-term treasury yields hit 4.8%, and now they're down to 4.2%. That should start feeding into the mortgage market. And while we may have 2 negative quarters here, a technical recession, they may not declare it a recession, just like they didn't declare, I think it was early 22, 2 negative quarters. They didn't declare that one a recession either, but nonetheless, negative is negative. The difference this time around, in 22, we were just beginning the rolling recession as rates jumped 24-fold. We believe we're ending this rolling recession. If most sectors are down and out, with small business being hurt really disproportionately by the environment we've been in the last 4 years. And, small businesses serve as the backbone of this country and account for a huge amount of job creation. That has been down and out. There was only one sector to go, and that was the consumer sector. Consumption had held up. Surprisingly and somewhat suspiciously. But now we're seeing in the last University of Michigan Consumer Sentiment Index, high-end consumers, their confidence has cracked now, joining middle income and lower income consumers. And it may be all of the chaos out there and uncertainty about tax rates and everything else. But Walmart rang the bell when it was willing to say it didn't like something out there. Last year, its same-store sales were 5%, and it was talking about how it was increasing share from high-end income earners. And this year, very early in the year, it declared, nope, it's not going to be sustained. We're talking 3 to 4%, which as a percent of 5%, that drop of 1.5%, that's a lot. That's a lot. So a need to readjust. Target and Best Buy and even Costco are saying there's incremental weakness out there. I talk about small business, just like to put up this chart. Look at how difficult the world has been for small business since COVID. If there's any one part of the market that is due for a reversion to the mean move. Thanks to deregulation and tax cuts and animal spirits, it is this one. And so we're pretty excited about what the next few years are going to hold for smaller businesses. You can see, interestingly, you go back into the mid-90s. I remember this period very well. Commodity prices took off in the early 90s, really hurting small businesses. And then in the mid-90s began the tech and telecom revolution, productivity gains, tax cuts, and I think we're going back to the future in the next few years. And then we'll just focus on a few market indicators now. You can see the yield curve here. The yield curve was negative for quite a time. It's turned positive, but not convincingly so. And I think we reached 40 basis points in terms of positive yield curve, where I think back down to 25 basis points. And inverted yield curves have tended to be harbingers of recession. You can see from the gray shaded areas there, inverted yield curve, then a recession. Well, we've had a rolling recession, and we'll just call it that. Maybe it ends in a formal recession finally, or maybe they backdate the recession, as the National Bureau of Economic Research is wont to do, because they declare a recession years later, typically. Now, yield curves, many people assume we need a strongly positive yield curve with long rates much higher than short rates, which you've seen in certainly since the 80s, since the Reagan Revolution. But if you look back even further, late 1800s, early 1900s, you'll see that we had an inverted yield curve during that period, most of the time, with the average being about 100 basis points. And you can see at the extreme, we got to almost 500 basis points. Why was that? We think it was because first of all, we had the gold standard, so there was a price rule, and we think Bitcoin provides the equivalent of a rules-based monetary system, like Bretton Woods did, challenging fiat currencies every step of the way. Not quite the same thing, but the other thing going on back then was massive innovation. Telephone, electricity, internal combustion engine, which led to, automobile, airplanes, and so forth, trains. So lots of innovation, people coming off the farm. And so the short-term yields would move up with the economy, but the long-term yields were much more focused on inflation, and so they stayed pretty low. And in fact, I believe the average back then, over that time period, over the 50 years ended in the Great Depression, was 3.8% on the long bond yield. Even though we were in a booming economy thanks to new technologies, we would not be surprised to see the same this time as well. I'll just go through a few other charts to reinforce what we've been saying over time. Yeah, commodity prices have had a little bit of a bump here. You have oil coming down, others going up, copper in particular, but still have hardly moved in the context of history. We're still where we were in the early 80s, the early 90s, the early 2000s. And then you can see that one of the reasons is the dollar's been going up. A lot of people are talking about tariffs really taking the dollar down because of fears about economic growth and recession. You can see in context what has happened here. Yes, we've had about I'm going to say almost a 5% decline in the dollar, but you can see in the context of history, it is still at the stronger end of a range that's been in place since 1990. And very importantly on this next chart, in taking metals relative to gold, the metals price relative to gold, in the purple line here, we're back where we've been during recessions. And the interest rate, however, has not behaved as it has historically. Interest rates have just hung in there. We're beginning to believe that the interest rate will crack now, and that will help housing, and that will be the start of maybe a rolling recovery, but if we're right and the tax cuts and deregulation unleash these so-called animal spirits, it's going to be much more than a rolling recovery. It's going to be a productivity-led boom. This is the yield spread, which is a good gauge of trouble brewing out there when it spikes. You can see the credit markets don't see any problems out there. And I find that interesting. I mean, these are focused on larger companies, not really small companies, and that's where the pain has been. So nothing to worry about, apparently. I'll just remind you, we expect this productivity boom to take us into a new orbit in terms of real GDP growth, 7.3%, up from 3% where we've been for the last 125 years. And you can see before that, before telephone, electricity, and the internal combustion engine, we were at 0.6%. So with each technology jump, and you can find this chart and its explanation in our Big Ideas 2025, with each technological leap, there's a leap in growth. And I actually think this 7.3%, given how many platforms are evolving, we have 15 different technologies, 5 major platforms, compared to just 3 platforms in the early 1900s. So I actually think that's pretty conservative. And then just to show you what we think is going to happen in terms of innovation and how it will evolve from a market cap point of view, you can see truly disruptive innovation depicted in the purple, Mag 6 in the turquoise. Mag 6 has had a magnificent run, tripled over the last 5 years, really helped by increasing concentration of the markets as people became very fearful of the environment. You can see that truly disruptive innovation only appreciated by 30-ish% over the same time versus a triple. Okay, we think that's going to flip in the years ahead, and that the market is going to broaden out significantly and reward stocks that have been neglected out of fear in the last few years. And while 2 steps forward right after the election, 1 step back recently, if you look at the innovation indexes out there and strategies generally, you'll find that there was a breakout after the election, and now there's a testing going back to that breakout. Whereas with the broader based NASDAQ, S&P, NASDAQ 100, you'll see a break in those indexes, and they are really struggling to get back to above their 200-day moving averages. So there is a difference. We've had a bit of a correction here in terms of truly disruptive innovation, but I do believe that this bull market it will continue to broaden out, and perhaps be one of the strongest bull markets in history if we're right, that real growth accelerates as inflation maybe even turns negative thanks to these new technologies. And just to end on some interesting charts our chief futurist Brett Winton whipped up this week. So here you can see daily active users by the various AI chats out there. Actually, a better view of this is a log chart view. And you can see how far ahead ChatGPT is relative to the others. You can also see what happened with DeepSeek, how powerful that move was, that aha moment. Many people here in the United States weren't paying attention to it until they published a paper about being able to develop R1 on a high-end workstation instead of using huge numbers of GPUs in data centers. Well, we don't think that's quite right. We know that the company backing DeepSeek has a 50,000 GPU cluster, and that it probably used it in pre-training, and maybe it developed the last leg of that model on a high-end workstation. But what's notable nonetheless is the technologists in the US, like Jensen Huang, Sam Altman, I think even Elon might have commented, the algorithms in DeepSeek were very interesting, very creative. And that's one of the reasons you see the uptake here. And you can also see Grok's daily average users just taking off. I mean, faster than DeepSeek did. It took a while to gather momentum. So don't underestimate Grok here. We think they're going to give ChatGPT a run for their money. And what's interesting is DeepSeek is open source. Grok says it will open source when it launches a new generation of large language models. So open source, Meta's Llama, large language models. Open source is a movement here, and we're really trying to think through the ramifications of open source stealing the march in some ways and educating others. You can see how dominant ChatGPT is. The share as of March 6th, it's just dominating in terms of the daily active user base. Now, I know the criticism here is going to be, well, Meta has 2 billion users around the world, and it's integrating AI into all of its services, and Google will say the same thing. But we thought that these more pure play looks at large language models was interesting. And finally, here's the daily active users added per day. You can see ChatGPT here again, the leader by far. You can see DeepSeek losing at the margin, so they need to refresh and keep the users excited. And there you can also see Grok really coming on strongly relative to Claude, Google Gemini, and Perplexity. So with that, I will bid adieu. And we'll see you next Employment Friday. Stay tuned for our market updates as we do every month. And again, in the know every Employment Friday. So thank you so much.
解说君备注：在今天的视频中，我们深入探讨了投资家凯西·伍德关于当前经济形势 政策变化以及市场趋势的演讲。他为我们提供了一个独特的视角，帮助我们理解全球经济在经历了多年的波动后，可能正走向一个新的阶段。凯西·伍德的分析涵盖了多个关键领域，从经济衰退的潜在结束，到财政政策和货币政策对未来的影响，从消费者信心的波动，到技术创新如何成为推动经济增长的核心动力。他特别强调了人工智能和其他颠覆性技术的快速发展，认为这些技术不仅将改变行业格局，还可能带来一场生产力驱动的经济繁荣。然而，尽管他的观点充满乐观，我们也需要保持清醒的思考，经济复苏是否真的如他所预测的那样顺利？减税和放松管制的政策效果是否会立竿见影？还是需要更长时间才能显现？人工智能和开源技术的普及，是否真的能带来广泛的经济增长？还是会加剧某些领域的不平等？这些问题值得我们每个人深入思考。凯西·伍德的演讲为我们提供了一个框架，但未来的经济走向仍然充满不确定性。作为观众，我们需要结合更多的信息和数据，形成自己的判断。如果你对凯西·伍德的观点有任何想法，或者对未来的经济和技术发展趋势有自己的见解，欢迎在评论区分享你的看法。别忘了点赞、订阅并开启小铃铛，以便第一时间获取我们的最新内容。感谢大家的观看，我们下期再见。